Well, alternative risk premia are systematic strategies that take advantage of structural market phenomena, often studied by academics in the past, most notably by Pharma and French in the equities factor space. These strategies have been adopted by hedge funds in the past, but in recent times is more widely available to investors under more favorable conditions, most notably in terms of liquidity and management fees. Putting all these risk premia together often leads to a low correlation to traditional asset classes such as equities and bonds, which makes it an attractive proposition for investors today. An example would be FX carry, for example, is a popular one, and that involves going long high-yielding currencies and short lower-yielding currencies. Well, we noticed that a lot of academic research has been focused on identifying and analyzing individual risk premia, whilst very little has been done on the asset allocation between these risk premia. With growing interest from investors into these strategies, we believe that this becomes an increasingly important consideration. Traditionally, a naive approach would be to allocate risk budgets equally across these risk premia. This often leads to overexposure to specific risk factors, and also it's often based on long-term assumptions which may or may not hold in the shorter term. Well, we took a top-down approach based on macroeconomic regimes. We broke down the business cycle into 4 key regimes, notably recession, inflation, market stress, and steady growth. We tested the sensitivity of individual risk premia to each of these regimes and noticed that whilst in the long run they may have comparable Sharpe ratios, these can differ quite significantly between regimes. Separately, we also investigated whether carry is a key driver in the returns of these risk premia. Now, obviously, for carry strategies, this is important. However, we also noticed that for some other alternative risk premia, this can be an important driver. Well, we found that we can build a robust strategic asset allocation that is resilient to different macroeconomic regimes and generate good risk-adjusted returns. However, this can be further improved if you add a dynamic asset allocation layer that tilts towards risk premia based on one, the nowcasters that identify systematically where we are in the prevailing market regime, and second, based on the expected carry of risk premia. In conclusion, our research found that by adopting a dynamic approach in portfolio construction can improve Sharpe ratios across different market regimes, but particularly during bad times.